Hey, what's happening? Trader Tim from EminiMind. We're going to jump into a trade recap video here, Thursday, the 27th of February, and we'll finish with some bigger picture daily charts on the ES. So looking at the ES this morning, very fast moving market. We're going to go down to a 1 minute time frame, slide this back to the morning. And the first thing that we had, well, we had a little bit of a gap up, and then we sold off. We did not fill the gap before the 15-minute mark. So we did get a 15-minute opening range breakout trade to the downside. That got a really quick plus 20 points. And then in addition to that, before the 15-minute traded, so this was at 7:44, we had a nice long hammer. We came very close to filling the gap, but we didn't quite fill it. But the hammer was, the key there as far as the entry goes. So long above the hammer, it got a really nice. This is what you love to see with these hammer and inverted hammer trades. The hammer is the signal bar, and then the next candle, the entry bar, gets a very strong initial push. So the entry bar doesn't trade too far into the prior bar. So see how here is the hammer, and then the low of the next candle is where the hammer closed, and then immediately we go up and then get your order filled one tick above highs, and then it pushes up from there. And then the next candle doesn't retrace too much either, so you're moving your stop from underneath the entry candle low up underneath the next candle's low. Unfortunately, it didn't rip. We rolled over and kind of started our downtrend. But these types of trades get a very quick risk reduction, and then following that up with another candle or two, and all of a sudden you have a profitable trade as your worst case scenario. So you're still in the trade, your stop is in profitable territory, and you just kind of keep trailing it up as you go. You can trail swings as well, so let the market pull back and then rally. That's a really good way to catch bigger moves, especially when you're trading with the trend. I'll scroll back to yesterday real quick because it was a really nice. Actually, sorry, it was Tuesday. Yesterday was nice too, but Tuesday is what I want to pull up here. And so Tuesday we started with a pretty stiff downtrend, and then all of the swing highs that we got, so like swing high, swing high, swing high, you can just trail your stop down above a swing high. So if you get in to, let's say the market opens up, you give it 15 minutes to settle out, start to develop a downtrend, you short below an inverted hammer or whatever the entry is. It doesn't have to be an inverted hammer. It could be a 50% retracement, and then or even just an inverted hammer up here at the 21 EMA, and then just trailing swings on the way down as you make a lower high, lower high, lower high, and just keep trailing them down to stay in the trade longer. That's a really good way to do that intraday and on a daily chart. That's what I've always done on like swing trades, and that works super, super well. So this first one went up for a couple, 2-3 points, and then I ended up, it wasn't exactly reversing. I had my stop under this candle, and then like 10-15 seconds later, this inverted hammer candle closed, and then I put in order to be one tick underneath that inverted hammer. That was a great placement right at the 21 EMA. Unfortunately, I got ticked out. It went right to my minus 3-point stop and took me out before it moved down. So it happens. Sometimes you get lucky and it goes your way. Sometimes you get a little unlucky. That one was the latter. So I didn't get this move down, but shortly after that, the 15-minute opening range breakout broke its low of the first 15-minute range, and then that got me into the 15-minute short, and then that one, like I said, made a really quick move down for plus 20 points. So that was nice. I did take, let's see, looking at my notes here, the 15-minute, and then the next one, 751. This hammer, I like the placement where you have a double bottom, but it traded so fast. The candle closed, and we were already trading 2 ticks above the candle. So if that happens, I just pass on the trade as opposed to kind of frantically trying to put in the trade and hope it comes back down and gets me filled. So it just happened too fast, so I didn't get in that one. I guess you could say that was a little bit luck to the other direction. So because it ended up not getting any follow through and really starting to solidify that downtrend. We have a high and then lower low, lower high, lower low, lower high. And so now we've established a downtrend. The 21 starting to roll over, but really wasn't trending super strong to the downside. But just by looking at the swing highs and swing lows, that's a really, really good way to establish the trend, both on a daily and weekly chart as well as intraday. Obviously, the bigger time frames are going to have more weight. It's going to take a lot longer for a daily and a weekly chart to break a swing high and swing low, and we'll close looking at those charts. Whereas intraday on a 1 minute chart or like a 512 tick chart, you're going to have a lot of smaller moves. It's going to produce a little bit more noise, but the trend change is going to start in the smaller time frame and then work its way to the larger time frame. So next note I have here was 758. This one was too close to the, or let's see, yeah, this one here. It didn't end up filling, breaking above its hammer, but the time of this one was 2 minutes before the, I believe it was pending home sales at the top of the hour. So I don't put on the trade inside of that, 2 minutes or so right before the news. Usually we have news at the top of the hour, so that's why I reference that. Actually, I think this one did break above. Let's see. It was a 55.50 and 55. So it did technically break above the hammer. But as we saw earlier, not getting the follow through above the hammer. We did on the first one. That went for a couple points. But notice it didn't even make it to the halfway back short. It got close to a 91. But the 50% was actually a 92.25. So that right there signals there's more selling pressure. The breadth and the AD line weren't overly bearish. But the other thing that you'll notice this morning is we had a lot of tick divergences early, meaning we had a low, nicey tick, and then 1 minute later, or following, most of the time it was like in the next minute or two, we had a new lower price. And so when we have that divergence to the downside, low tick, and then we get a low price following it, that's indicating that we're going into a downtrend. So then the next one, 806. Short off by a tick, good setup. 806, where are we? Oh, this one was great. Unfortunately, it didn't get the follow through. We actually ended up ripping pretty well back into the 30-minute range pretty strongly to the upside. But great setup. Take this one all the time. And it's important to disassociate the outcome of the trade from it being a good or bad trade. So if you just went through all your trades and said, all of my winning trades were good trades, all of my losing trades were bad trades, you're going to end up with a whole lot of bad habits and find trading very difficult, more from a psychological standpoint, because a lot of times there are setups that we take over and over and over again, and let's say 7 out of 10 end up being winning trades. It doesn't mean that those other 3 trades were bad trades. It's just that the statistical set, you're going to have some losers in the mix. And at the same token, I could just come in and just start firing off trades, hitting buy market, sell market, and get lucky and have a winner. And I wouldn't call that a good trade. There was no rhyme or reason for it. So you want to, break those two apart and focus on the quality of the setup using the information that you have at the time of placing the trade to make the best decision about, should I take the trade or should I not? So we have value area low here. This 47.75 is the 30-minute low. And then we traded below that. And so with a lower high, inverted hammer, nice little setup, but it didn't end up rolling over. We came to the 50% long and then traded back to the upside. This wasn't really a hammer here. I'm going to get rid of this 30-minute low just because it's so close to the value area low, kind of clutters the chart. But I would call this a spinning top, not a hammer. But I like that it came down and touched the 50%. And we were trading this being right at the value area low. So I know we were chatting in the Discord, and some people took that trade, and that's fine. You have the higher low, you're coming off of the 50% retracement. That's where the support level is. And so you're kind of following that up with a push above the 30-minute low and then coming back into value area low. So some decent trades. It was pretty fast moving this morning, and that's okay. Definitely a lot better trading than we've seen in the last few weeks. I mean, 15-minute, we've got 4 in a row, 20-pointers. So we're on fire there. And a lot more 1-minute trades, halfway backs as well. One thing I will mention is when the market gets moving fast, the hammers and inverted hammers, I mean, you got to be on top of it. You got to be looking. So in Thinkorswim, I got this countdown clock up here on the left. I'm sure your platform has a clock, or you just use your computer clock. And boom, 59. And then as soon as it changes, I'm ready to drop that order. So as the candles are forming with the hammers and inverted hammers, I'm like, okay, we're only at 10 seconds, so I got a whole 50 seconds to wait. I kind of hover my cursor over the price, and then I can see up on this top bar here, when I hover it over the price, the high and low of the candle. And then as we're starting to form a hammer, let's say, I can find the high price and then be ready to drop the order. However, the retracements are going to be a lot easier to get in when the market's moving really fast, because you're drawing a setup. Okay, you're identifying, okay, here we go, higher high, higher low, higher high, higher low. You got the trend going, boom, you break the swing low, and you break the next 60-18 as well. So you draw it in the other direction, and then you have a couple of minutes, or at least a minute or two, to draw up the retracement, look at the price, put your order in 87.50, and then it's a limit order, so price is coming up to it, and so you're not going to have slippage like you would potentially on a market order, even when the market's moving this fast, which is not that fast. It's just people aren't used to it because we've been in such a low volatility environment. But on the ES, you really don't get much slippage at all. And so the retracements can be a helpful way to kind of slow things down at times, even on the 512 tick chart, even though it moves quite a bit faster than some other charts. But just looking for either a swing high to break, and then drawing up a retracement in the other direction as a form of starting a new trend, or you've got a low to high drawn, and then you make your way up to the negative 23, and then draw from the 50% to the next, to that negative 23, and put your limit order out to 50, take it up to the next negative 23, and just kind of keep doing that in the same direction. Once you get in, you can trail swing lows. You don't have to exit at the negative 23 and then re-enter, and then exit and re-enter. You can just put your stop underneath the swing low and then trail the next swing low. I like to start by trailing the next 60-18 and then move to trailing swing lows. And then if you do start to rip really fast, you can come in and trail each candle if you want. That's a good way to lock in profit without just frantically closing the trade and potentially either making a mistake or just leaving a lot of profit on the table. So look to the retracements. We've had some good trades, good retracement trades lately. The 1 minutes have been starting to fire off really well, and 15-minute breakouts also rocking and rolling. So overall, things have really shaped up nicely this week. We'll go out to the daily chart here. This low, this 50.25, I talked about it last week being a key level. This is the weekly low. And if I switch to the weekly chart, we can see that is the swing low here. Look at all these bottoming tails below that low. Hammer, spinning top, and day hasn't closed yet, but at the moment we're at a hammer. So it'll be interesting to see how we close today. And then draw the next 50% retracement on the daily chart, and then watch that level. So if we rally from here without making a new low, you're at a 60.45, and watch that level for a potential short, either to buy puts at or come down to a smaller time frame and short on that time frame. I always wait to buy my puts at the close. So if we open up tomorrow and we start moving higher, and we rally all the way through the 50%, blow through the 60-18, and close somewhere above the 60-18, well, then there's no short trade. So wait till the close to put those on. But if we come up to the 50% and we're getting, into the last 20, 30 minutes of the day and we're right around the 50% level on the daily, I will buy puts as a way to hedge my long-term position. And then you're on the backside of the trend line. You've broke the swing low. And so this would be the first potential short entry in that move. But don't be surprised if we come through and just, all of a sudden rip and we're trading back up at all-time highs again. Sometimes these scenarios that don't sound very likely or seem very implausible are exactly what ends up happening, because you have a lot of people that are thinking, well, that's not going to happen. And a lot of people have stop orders out there or are just planning to trade in the other direction. And as soon as they start losing their shirt and their position goes underwater, or they get caught off guard and it's like, wow, the market's ripping, I better get back in. So you have the fear of missing out, and then you start chasing it. And then next thing you know, all of a sudden you're back in all-time highs, and you were short and stayed short from down at lows. So try to keep an open mind. Try not to focus in too much on the news and the naming a reason for why the market's going up and down. Just focus on the chart itself and the technicals, and all of that outside information will make itself known and visible in the chart from a technical perspective. So lots of good stuff going on this week and should continue. Our volatility is not crazy high, but just by the size of the candles in the daily, the ranges you can see have expanded a bit, and we've gotten out of this consolidation that we were in last week. And then more importantly, we're kind of in, I have it drawn up as a triangle here, but we were kind of in this larger rectangle for the last month, and kind of this being the top half of the rectangle, and then some time down here with these couple of days that broke down below the lows, but all of these tails here kind of solidifying the bottom of this lower rectangle. So big consolidation that we broke out of, and we're ready to continue the trend of lots more good trading. So hope you have a great rest of your week and a great weekend. We'll talk to you soon.